I am Todd Emmel. I'm a partner here in the Cincinnati office, and I lead our EY private for this region. And we have been getting lots of questions from our privately held clients, as well as angel investors that we know and financial advisors on SPACs. And hey, what are they? How do they work? Are they good for me? Is it something that I should consider for my company, or if an angel investor, investing in? So we thought it made a lot of sense to open up this topic to all of you. And as John said, if you have questions, please ask them through the comments. You can ask me directly or to everyone, and we will make sure that those get answered. I'd like to introduce my team to you now. And Lou, do you want to start off?
Absolutely. Thanks for everybody for attending today. It looks like an awesome show. So thanks for joining us. Lou Doth. I'm out of Minneapolis. I'm in our accounting advisory practice, and I serve as the Central Region leader for our SPAC team. Our SPAC team is basically a group of dedicated professionals across multiple disciplines that have been together, focusing almost exclusively on SPAC transactions for about 5 years. So a little longer than a lot of you are probably have been familiar with SPAC products. But our team, founded by Kareem Anani, who some of you, if you've attended webcasts, may be familiar with them or read or seen articles. Kareem is the leader of our group, along with Alex Luag and myself. And then, Dan and Mike were going to do themselves are part of the team too. But we've been involved in now over 140 SPAC transactions, and we've of those 140 that we've been involved in, about 100 have closed. So we have a lot of really good experience, and we're really excited to share some of that experience with you guys today.
Mark?
Sure, and thanks for having us. So Mark Schwartz, I sit in our equity capital markets advisory practice out of New York. We are a group of all former investment bankers. I spent 15 years at Barclays and Deutsche Bank, and at EY, where we sit, is we complement Lou and his team, but really on an independent transaction advisory role. So sitting in between companies that are considering merging with SPACs and the Wall Street players that are there, kind of taking them all together. So pass it over to Dan.
And Dan?
Good afternoon. I'm Dan White, and I run the Chicago M&A tax or transaction tax practice. And like Lou, part of the multidisciplinary team that is doing the SPAC work in our region, which really is quite large. So it covers quite a footprint. And I would love to say that SPACs have been full-time for the last 5 years in my world, but that would not be true. But it is a larger and larger part of what is going on in the M&A tax world, whether it's from a company liquidity side or from a sponsor side, including the corporations are beginning to sponsor SPACs. So we're got a lot to talk about.
Awesome. So today we thought we would discuss, some of the nuts and bolts about what a SPAC is. IPO activity, SPAC IPO activity, comparing alternative paths to accessing capital markets, current trends and expectations that we're seeing, a deeper dive into how they work. We'll get even deeper from a tax considerations, although we've all threatened Dan not to bore you all with too much of the tax code. And then we'll open it up and try to address some of the questions that we've received if we haven't been able to answer them during the session. So at this point, Lou, I think I'll turn it over to you. I'll continue to run the slides for you, but you can take it from here.
Fantastic. Yeah, just advance to the next slide. That's perfect. And the goal for today here is we'll probably have about 30 to 40 minutes of kind of content to talk through with you guys. So for all the participants here, please use the chat box to share your questions, and Todd's going to be kind of cataloging those, and hopefully we'll have a kind of a robust and rich Q&A here for the last 20 minutes of the hour. So thanks in advance for all of your active participation and what I'm sure will be really good questions. So what is a SPAC? We'll go through this relatively quickly. Most of you are probably familiar with the concept and what a SPAC is, but just to level set everybody, a SPAC formerly known as a blank check company. The blank check companies, they actually originated in the 1980s. So while it feels like SPAC is a really relatively new concept, it's actually very, very old, almost 30 years old. The SPAC product is, and initially were called blank check companies, and probably in the early to mid 2000s, those were kind of rebranded as SPACs, special purpose acquisition companies. So SPACs haven't always had always been kind of the darling of the capital markets as they are in 2020 and 2021. A lot of times there was some negative connotations with the economics around a SPAC transaction, and a lot of those economics, while they've remained somewhat the same, there has been some recent evolution and trends in how SPACs are structured that Mark is going to talk through a little bit. The SPACs are essentially founded by a group of sponsors who are either well-respected financial institutions, investment houses, or potentially a private investor that's leading a group of sponsors that has experience leading public companies in a particular sector. The sole purpose of the SPAC is basically to raise capital to merge with a target company and be a combined public company following the approval of that merger. So the SPAC itself goes through a very similar IPO as a traditional IPO company would. It's a relatively quick process, and quite a bit quicker than a traditional IPO that, if any of you have experienced that on the call here, can be a 4 to 8 month process with the SEC as the SEC reviews the IPO, etc. In our case here, the SPAC is only listing with basically cash and equity. The SPAC issues shares typically at $10 a share, and then there's some form of warrant that kind of gets attached to each share to basically create a unit, which is generally a share to maybe a third of a warrant, and 3 warrants together would be exchangeable down the line for a share in the SPAC. The IPO process for the blank check company is relatively quick, and then immediately once the SPAC goes public and goes effective, it is subject to all the SEC requirements that a traditional IPO and a regular public company would be. So they'll have to file 10Qs and 10Ks, etc. But they're immediately, even before they actually go live as a public SPAC, they're starting to identify potential targets to merge with. So we kind of analogize this to kind of like a snowball dance from when you were in junior high and maybe 8th grade. It was a little awkward at first, but then eventually you have certain dance partners, and eventually you find your partner. Well, the SPAC matching process isn't too dissimilar, where the SPAC will take a funnel of anywhere 80 to 100 targets, and eventually funnel those down to a smaller number of targets for which they then engage in discussions with. They ultimately enter into an LOI and then go through kind of the process to create a merger agreement and hash out terms, and ultimately the agreement needs to be approved by the SPAC shareholders. So the SPAC itself, again, it just has cash in it, and SPACs, based on the kind of legal form, typically have 18 to 24 months to complete a transaction. So the clock is on, and the incentives are quite high for the SPAC to quickly identify a target, get into the negotiation process and into the PIPE process, which we'll describe a little bit later, and ultimately find their dance partner.
Lou, got a question for you. So if these have been around since the 80s, why does it seem like the SPAC craze suddenly just came about?
Great question. I think that's probably a natural move to Mark and some of the items that he has about, because Mark always does a really good job to kind of describe actually, why SPACs are so popular now and kind of what happened to move that into the limelight.
So happy to pick up. And I think what I'll do is I'll try to bridge the gap from kind of these things have been around for 30 years to what's happening in the last, call it 18 months or so. I actually need to go back about 5 years or so, where there were some very significant structural changes in the product. In particular, and I'm not going to get into the details on the call, but in particular, there was a decoupling of the redemption mechanism from the shareholder vote. That really opened up and opened up the possibility of what's happened in the market to happen, because it really kind of it reduced a lot of the execution certainty in a SPAC transaction and allowed the transaction, the product to actually work a lot better. If you fast forward to the beginning of 2020, right before the world really changed, there was a lot of things going on in terms of a perfect storm that kind of created what you see on the page, going from, call it 18, 19, all the way to 2020 as this first big blip. In particular, we had all the volatility settle into the market, call it towards the end of Q1 last year. At the same time, the private capital markets got much more constrained. Pricing and availability in the private markets private capital really dried up. So companies that had been funding themselves for a very, very long time, and everybody's aware of the trends of companies staying private for longer, that wasn't as, I'll say, a viable alternative. At the same time, you saw companies that had public listings, the value of their public listing came to the forefront with all the rescue financings and the access to capital that those companies had. So also at the same time, in terms of this perfect storm, you had a couple of high-profile de-SPAC transactions that really captivated both retail investors as well as the media. You had DraftKings, you had Virgin come out and perform quite well. And then the final factor there in all of this is this low interest rate environment that we're in, allowing capital to form in what's effectively a riskless or near riskless vehicle in these SPAC IPOs allowed just a ton of capital to come in to the market to see these vehicles. So then you started this snowball effect as 2020 went on. Higher profile sponsors started throwing their hats in the ring, really lending credibility to the product, to what it was, a product that I think for a very long time had a tarnished reputation, and it really was a path of last resort for companies to get to the public markets. But now you had true high profile sponsors that had fantastic reputations kind of entering into the game. You saw all this market depth. We'll talk about sort of the consequence of the market depth. You saw retail investors get much more involved in the transactions, and now, frankly, it's all over CNBC. Every retail investor, I think, is aware of the SPAC phenomenon. And then, as a final leg of the stool, you had a whole bunch of higher quality companies that in any normal market would come public via a regular way, traditional IPO, using this path because of some of the benefits of the product that we'll talk about in a few minutes. But as you started getting higher quality companies come to the table for SPAC transactions, and as you had higher profile sponsors out there, you started seeing just this continual snowball effect. So that leads into perfectly what's on this page. So 2020 was clearly the year of the SPAC. Everybody talks about it like that. There were 250 SPAC IPOs last year. That actually is more than the number of SPAC IPOs in the preceding decade. So you could see 2020 really kind of just a crazy, tremendous ramp up. 2021, by all measures and accounts, will absolutely become the new year of the SPAC based on everything that we're seeing. If you just take a pause and take a look at where we're at today, there are currently, as we sit here literally at this moment, there are 430 active SPACs out there looking to deploy capital. In those SPACs, just in those SPACs, in their trusts, they have about $140 billion of capital that needs a home. Otherwise, the SPAC sponsors lose their at-risk capital, and we can talk about that. On top of that $140 billion that's seeking a home, there's also this pipe market that is very much complementary to what's going on here. And here we're talking about, call it regular, long-only fundamental investors in companies that are effectively pairing up their capital in these transactions with the cash that's in trust. The size of the pipe market right now is probably another 140 or 150 billion dollars of available capital that will be chasing deals. So in terms of this activity, as the year went on last year, Q4, every quarter it just kind of continued to ramp up, and you can see how I think it's second half versus first half in 2020. Second half was the lion's share of what happened there. But if you fast forward to 2021, because I think that's really the story today, sitting here at the end of Q1, in Q1 of 21, there were 300 new SPACs just in literally the first 3 months of the year. $100 billion of capital in those trusts, the additional pipe capital sitting on the sideline with it. The number of new vehicles, as you can see on the chart, in the first quarter has already exceeded the full year of 2020. So there is so much supply, and that's the market depth sort of aspect of what's going on here. There is so much supply, but the true consequence to this is that these SPACs are now more competitive on valuation than they ever have been in the history of the product in these 30 years. And as a result of this competitiveness on valuation, what you're seeing is just tremendous merger activity. So if you take a look back at 2021, about a quarter of the new public companies that entered the market came public via SPAC versus regular way IPO. So as compared to historical standards, the 25% is just, it's new world. If you take a look at what's going on thus far in 2021, new SPAC merger announcements are on pace pretty much neck and neck with traditional IPOs. So we're right now in the 94, 95 area of new SPAC mergers announced, which is roughly the same number of traditional IPOs, traditional companies that have come public via traditional IPO. If you take a look at the aggregate transaction value of these 95 or so SPAC mergers, you're talking about $250 billion. So $250 billion of aggregate transaction value going through this market. So it is no wonder that management teams are looking at it, boards are looking at it, owners are looking at it. There's really not a conversation that goes by these days where we are not discussing in some form or fashion the SPAC market. In terms of the companies that are coming out, by and large, the overwhelming majority of the companies that are being pursued in these mergers are founder-owned companies with some VC money in there. Sometime in the back half of last year, we started seeing some private equity sponsored companies come public via SPACs. We've also more recently, and the dialogue has ramped up tremendously, we've also more recently seen carve-outs from existing public companies merge with SPACs in what's effectively a carve-out IPO or a spin-out through that process. So the universe of companies that are coming public via this just continues to expand. Like I mentioned before, it used to be that if a company couldn't come public regular way, they would talk about the SPAC route. But now we are seeing companies that have been in the IPO pipeline for a very long time and that would fit all of the boxes or check all the boxes from a regular way IPO perspective. They're just looking at the SPAC path for the reason that I mentioned before, which is the product just works. So Todd, if you don't mind, if you go to the next page, this is sort of an eye chart. It's probably a better takeaway than it is a discussion page. But the reason, there's a couple of really strong reasons why the product is well positioned to take off. And I've said this in a number of meetings. Lou's probably tired of hearing this. I actually think that if SPACs were invented, if you will, 2 years ago, and they had a name like Optimized IPO or IPO 2.0, instead of continuing with the SPAC name that had some taint from prior years, I actually think the explosion would have been even greater. And that's for a couple of reasons. One, I talked about their competitiveness on valuation for sure is driving a lot of the activity and the attractiveness for private companies. Two, the SPAC product is just by its nature less market dependent than a regular way IPO. It's also less market dependent than any sort of other path, but it is in a SPAC transaction, and Lou's going to come back on in a minute and talk about what the process actually looks like. But in a SPAC transaction, everything from valuation to structure to terms to amount of cash that goes on the balance sheet to amount of cash that shareholders are able to monetize in the transaction, everything is negotiated upfront. Everything is negotiated confidentially, privately. Even the PIPE commitment process is done on a confidential basis. It is not until the actual merger agreement gets signed and all of the terms are completely baked and locked in that the transaction gets announced. So you're not dealing with, like you are in the regular world, a regular IPO world, you're not dealing with, I need to flip public 15 days before I'm going to go do my roadshow. Then I'm going to be out of my roadshow for 6, 7, or 8 days. At the end of that, I'm going to look to price my IPO, and it's going to be very much dependent on market conditions at the time, what the comparable companies are doing at the time. This is a done and dusted process while you're private. It is subject, in fact, to the SEC process, which takes about 2.5 or 3 months once you announce publicly. But the transaction risk between merger agreement signing and merger closing and trading of the combined company is greatly, greatly diminished. And in fact, the number of companies that don't make it to the altar on the back end is extremely low. So execution risk, ability to be insulated from the market, all fantastic benefits, if you will, from the SPAC path. There's also a tremendous amount more flexibility in the SPAC product. So traditionally in an IPO, you end up selling about 10 or 15% of the equity value of the company. Those proceeds largely go to the company as primary capital for growth. That's where investors in the IPO market generally want to see that capital go. In the SPAC market, it's different because you have all this cash in trust. You have all this PIPE capital that comes in alongside of it. Your ability to fund for longer by putting cash on the balance sheet is greater. And frankly, in the SPAC context, the ability to clean up, if you will, the cap table or provide more monetization or greater monetization for some what might be considered unnatural shareholders. So a founder that left the business 3 years ago is no longer subject to kind of wait for, post lockup in an IPO, et cetera. There is a lot more capacity in the SPAC transaction for existing shareholders to get liquidity out at the time of the transaction, at the time of the merger close. So flexibility. And then the final thing I'll mention, just to summarize this slide in total, the final thing I'll mention is that the path from private to public is absolutely expedited in a SPAC merger versus a regular IPO. It is not uncommon, given some of the trends that we're seeing, and I'll talk about that in a second, but it is not uncommon these days for a company to start talking to a SPAC sponsor, call it day one, and 6 months later, they are traded on an exchange as a combined company. That type of a ramp, basically getting tapped on the back by a sponsor and then getting public in, call it 2 to 3 quarters, that kind of a ramp is not how the IPO market works. It is a much slower, more deliberate process on the IPO preparation side, and then on this market timing side, et cetera. So Todd, if you don't mind going to the next slide. I'm going to wrap it up here and then toss it back to you, Luke, I think. So in terms of what we're seeing in the market, I think what I'd say is this entire phenomenon is happening so fast. 12 months ago or 18 months ago, nobody would have wanted to have a webcast topic on SPACs. Companies just weren't considering it like they are now. The conversation is coming up. If a company is thinking about a strategic, a sale to a strategic or a strategic, any sort of a sale, they're also considering a SPAC transaction. If they're thinking about an IPO, they're also considering a SPAC transaction. And frankly, even if they're considering a Series B round or a Series C round, they're thinking, well, instead of just taking a sliver equity and then continuing to grow off that and coming back for a C round or a D round, et cetera, they're actually thinking, should we just go for this big bang equity recapitalization transaction through a SPAC? So SPAC is coming up as a strategic alternative for each and every version of the strategic transactions that are out there. And we're having just these dialogues just constantly. The second thing I would note in terms of what's going on in the market is all of this is happening faster. SPACs are finding targets quicker post-IPO, much quicker. There's actually a record just broken within 4 weeks of a SPAC IPO. It just happened. That SPAC just announced the transaction. So some of this, if you take a look at the averages, if you take a look at the class of 18 or the class of 19 IPO to SPAC merger, you're talking about 16, 17 months. It is down to single digits, in a lot of cases mid-single digits in terms of number of months that these transactions are getting announced. So SPACs are finding targets quicker. The PIPE process has gotten absolutely institutionalized. Everyone knows exactly who to go to, exactly what information they need, exactly how to sequence it, whereas the PIPE process, which generally occurs, and Lou will talk about this in a second, generally occurs post-LOI signing and pre-merger announcement pre-merger agreement execution.
Mark,
that process used to...
Just to interrupt you, I'm not sure we've really set folks up for what a PIPE is. So do you want to quickly just clarify that one?
Happy to. Great call out.
And Mark, when you're answering that, I did get another question in the same vein of the SPAC sponsor. So you made the comment everyone knows who to go to. Actually, not everyone knows who to go to. So how do the SPAC sponsors work, and how would companies, get discovered by a sponsor to get into the PIPE?
Okay, let me start with the first part, and Lou, you should feel free to add on. So what is the PIPE? Okay, so start there. The SPAC, through the IPO of the SPAC, has $200 million of cash. That $200 million is inside the SPAC. It's inside a trust. It's basically untouchable. Typically, a $200 million SPAC would merge with a $1 billion company. Part of the funding to bridge this gap would come through the inclusion of additional PIPE investors. PIPE, once again, private investment in public equity. So the SPAC ends up, once it identifies the target, comes up with this LOI, so non-binding LOI that has called high-level terms. They decide effectively the size of this additional investment that they need to get. The PIPE investors, once again, are these fundamental long-only investors that would be effectively at the top of your book if you went regular way IPO. So Fidelity, Wellington, Barron, BlackRock, Franklin Templeton, all the usual cast of characters. The sponsor effectively brings the PIPE investors or potential PIPE investors over the wall, so the confidential side, does what's effectively a roadshow for these PIPE investors. At the back of that roadshow, the PIPE investors sign PIPE commitments, sign up for, let's call it the additional $200 million that they will use to help fund this acquisition.
What do you think? You probably thought about Carolina. Some of you might have been at a Home Depot or a Lowe's.
All right, someone needs to go on mute if you could. Thank you.
Sorry, not sure if that was a question. So in terms of just flow of funds, what ends up happening is once the PIPE commitments are provided, the merger agreement gets executed, and I don't want to steal the process thunder here, Lou. The merger agreement gets executed. On the back of the execution of the merger agreement, it gets announced publicly. You start that SEC process. At the time the merger is closed, that's when the PIPE investors actually fund their commitments. So think about the PIPE investors as effectively crossover investors in an IPO, where they're investing shortly before the company comes public. They're investing in what's effectively the combined operating company plus SPAC. And Dan, I actually already forgot the second question.
How do you get introduced to sponsors?
Good. Okay, so there was actually, I think the way you put it the first time was how do you get introduced to the PIPE investors? But I think if you just take it in sequence, if you back up, and once again, this stuff is just changing so fast. If you back up to last summer, it used to be that sponsors would go out and tap companies on the shoulder, and the company would, look up and say, hey, sure, let's talk about it kind of thing. What's happened now, because of all the depth and the breadth in the market, is that's still happening to some extent. But really what's happening is companies are so alert to this market now that they're going down the path of getting themselves ready to be a good candidate for a SPAC. What they're doing is they're hiring financial advisors, so basically a Wall Street bank. They are then conducting what's effectively, it's called a SPAC off. It's a bake-off for SPACs. So they'll come up with a list of anywhere from 5 to 35 potential SPAC partners. They will then effectively reach out and begin that kind of dating process to figure out where there's mutual interest between the SPAC sponsor and the company. If you fast forward, I think I made the comment that everybody knows who the PIPE investors are, and that market's getting institutionalized. So once the company and the SPAC have a marriage in the form of an LOI, and then they go look for this PIPE capital, all of the large investors are now perfectly well built and perfectly in the market seeking these PIPE investments. So all the Wall Street banks, all the sponsors know exactly on day one who they're going to call to effectively fill out this part of the transaction, the PIPE part. So hopefully that answers the question.
Great, thank you.
I saw a bunch of other questions. Do you guys want to, Todd and Dan, are we switching over to Q&A?
No, continue on.
I mean, hopefully folks are finding this useful. I think it's a little bit organic, but helpful. Mark, is it fair to think of there as like a minimum viable size for a public company generally, and that IPO or SPAC, that really doesn't change?
So great question. The way the market is today, you basically take a look at the size of the SPAC, and then the enterprise value on a combined basis of the two companies is generally about 3 to 5 times larger than the amount of cash in trust. So $200 million SPAC, you start looking $600, $700, $800 million when you're putting these companies together. The reason for that is because the SPAC comes with inherent dilution. So as part of setting up the SPAC sponsor is required to put in a few $1 million of at-risk capital, their own money. In exchange for that at-risk capital, generally, and it's not one size fits all, but there's a very, very strong general structure. In exchange for that at-risk capital, the sponsor takes 20% of the SPAC post-IPO. Because the SPAC sponsor is not paying effectively the same price that the public shareholders are paying, there's the inherent dilution when you combine the two entities. So the sponsor pre-combination has 20% of the SPAC. Post-combination, if you had a company that was the same size as the SPAC, the dilution would be way too great. So when you combine the SPAC with a company that is a few times larger than the SPAC, that 20% generally goes to call it 3, 4, 5% of the much bigger entity from a dilution perspective, which is why the which is why you have that relationship of size of company versus the SPAC. To answer your question truly directly, SPACs range right now from $50 million in size up to the biggest one is $4 billion. There's a couple of $1.5 billion ones. The sweet spot is around 250 or 300 million. But if you take a $50 million SPAC, and then to your question directly about how small can you go, you're talking about a $50 million SPAC. If you multiply it by 3 times or so, you kind of get to kind of the minimum size, if you will, in today's current market for SPAC deals.
And maybe chalk this up to 2 decades in a law firm, but when I see a whole lot of money chasing not a whole lot of deals, if I'm on the target side, so to speak, how often are you seeing folks say, your 20% dilution is charming, but I really don't think I think it ought to be half that. Is that a more and more present part of the conversation?
That's just about most deals. So all of these deals, as a general rule, start off with this, call it 20% promote plus the founder's warrants for additional dilution at some higher price. The conversation, depending generally on the attractiveness of the target and where the negotiating leverage resides, it is quite common for the 20% promote to get negotiated down. It is quite common for a portion of those shares to get pushed into an earnout to better align the sponsor's interests with the shareholders, combined company shareholders' interests. So what they might say is, we'll take 50% of our promote. We'll take 15%. We'll just forfeit it. We'll take another 10%. We will transfer it to the target company shareholders, and we'll take another 15% and we'll put it into what's effectively an earnout. So at $15 stock price, you can earn a percentage. At a $17.50 price, you can earn a little bit more. So that's how these deals are getting done.
Makes sense.
Okay.
So does it make sense to, I know we've kind of jumped straight to the market side. Do you want to talk for a few minutes about kind of accounting issues? Maybe I'll talk for a few minutes about tax and kind of see what percolates up from the crowd.
Yep, that sounds good, and appreciate that the market stuff is always kind of the fun stuff to talk about. So Mark always gets the fun parts. In terms of the process itself, I think we've done a pretty good job talking through how the sponsor comes together, negotiates LOI, talks to the pipe, and then you have the announcement and the SEC review process. So that this slide kind of captures what we'll call the deal process and the SEC review process. What I spend most of my time doing is helping companies make sure, and you can go back one slide, I think that's fine. As you look at the process, the deal process has to kind of have, it's what I'll call one of 3 legs on the stool. The other leg is, what are the requirements that have to be filed with the SEC? So a lot of companies that are, a SPAC knocks on your door on day one, let's just say, wanting to execute a transaction and merge with the company and be a combined public company, the kind of minimum requirements to be transactable, as Mark has coined the phrase that I like to use a lot, is the requirements of an SEC filing. So the company that's going to be merging with the SPAC as part of an S4 filing or a proxy filing, which is the document that will need to be filed with the SEC and ultimately get approved by the SPAC shareholders. That document requires minimum of 2 years PCAOB audited SX level financial statements. So in terms of the long poles in the tent, what are kind of the long poles in the tent to get to that transaction announcement and then subsequent filing as quickly after as you can? Because once the announcement's there's market pressure on the 2 parties to file the proxy. So a lot of private companies that are kind of getting approached by SPACs, they haven't been through kind of the process that is more well thought out that a lot of traditional IPO companies go through, and that's the big block on the bottom: target company readiness, public company readiness, as well as getting through the kind of required financial statement assets to be included into the SPAC. So a lot of companies are having to go talk to their auditors and say, hey, first and foremost, you need to make sure that you can do the audit because you got to be public company independent. Second, you got to perform procedures as part of the audit at a lower threshold. Third, you needed financial advisors, typically to supplement the accounting and finance function to make sure you get memos, potentially valuations, incremental disclosures, upgrades to the financial statements. And then as part of the filing, you'll need pro forma financial statements under Article 11, as well as like a full MD&A that complies with all the SEC guardrails that need to be in place. So that whole process that's kind of going on concurrent with the negotiation, the PIPE process, et cetera, is an extremely important process. And as you can probably envision with a small company, it puts a lot of pressure on resources at the company, particularly in the accounting and finance function. So CFOs, controllers are extremely, extremely busy during this process. And then maybe the most important thing before I hand it off here to Dan is you can do all this great work and get an amazing valuation as part of the deal negotiations, and that process can go great. But if the company is not prepared to kind of come out of the gates following the announcement, or that following the closing of the merger, and is ready to operate as a functioning public company with IR function, legal counsel, timely production of financial statements, a HR function and a tax function, not to be remiss there, that are able to kind of follow the requirements of a public company. If you're not doing that and you miss your earnings estimates for your first quarter, first year, or you file late, you could easily lose a lot of the value that you work so hard to kind of produce as part of the deal process, shortly coming out of the gates as a public company. So it's even more important to make sure you're public company ready as a SPAC who could be getting pulled 2 or 3 years earlier into being a public company than you might have otherwise done. It's even more important to make sure that you're ready to kind of hit the ground running. So I think I did mention tax as part of that. So I think this is maybe a good segue to Dan in terms of tax and tax planning and what you need to be thinking of.
Lou, it's like a well-oiled machine. So usually when we say we're coming to the tax part of the conversation, most folks get up and get a cup of coffee or turn the volume down and take another call. So I promise to not go there like a typical tax person. What you have here are 4 slides that will probably be more meaningful to folks who are tax minded than not, but let me at least kind of give you the broad brushstrokes here. If you are sponsoring a SPAC as a private equity person or as a corporate, Liberty Media, Post Holdings have both sponsored SPACs as publicly traded companies, and based on the conversations we're having and hearing, there's more to come. So there are a universe of issues that sponsors need to deal with. But from what I expect are folks here, which is a universe of people saying, what if I'm going to be the target in a de-SPAC transaction? How do I think about taxes? And I would say that the critical things to think about are making sure that first, do no harm, right? So if you have equity today and end up with equity after the transaction, make sure that what you did was get that equity or exchange that equity on a tax deferred basis. The second is, what can I do to do better in the transaction via tax? So oftentimes, and this would be on the next slide, I believe, in these exchanges, oftentimes if there are valuable tax assets historically, net operating loss carry forwards, or we're seeing more and more aggressive asks around getting paid for tax attributes, including, your company bought assets from someone else last year or 3 years ago, getting paid for that amortization. There are, in addition to the upfront IPO proceeds, folks are getting what are called tax receivable agreements, or TRAs. And what that is contingent consideration. above and beyond the trading price. And those TRAs can either be for historic tax attributes or for future benefits. So if you are currently organized as a partnership or an S Corp, or you're a division, what is being de-SPACed is a division of a company, and you're going to be, you can functionally sell assets or generate tax depreciation deductions to a buyer in the future, you can get paid. So if you imagine that, you know, most companies, the most valuable asset on the balance sheet are intangibles, brand and goodwill and the like, you know, that's a 15-year asset, straight line depreciated. And while you can't get paid 100% of the tax benefit, you can get paid 85%. And while I know you'd love to get paid on a present value projected basis, institutional shareholder services won't let you get away with that. So you're going to have to wait and get paid on a when and as benefited basis, but that can easily add, in the current tax rate environment, 10 to 12% on a present value to what your equity is worth through the tax receivable agreement, just on go forward benefits alone. And so the same can be true, you know, everything else is kind of gravy in terms of getting paid for historic tax attributes. And what is quite interesting, especially with today's proposal from the White House, with tax rates potentially going up, is some pressure, some forward pulling pressure to close transactions now while tax rates are lower. You can get capital gains even if you're recognizing gain in excess of $1 million at, you know, the current 20%. And then those benefits might be taxed at a new higher corporate rate at 28%. And the fact, if rates keep going up under a TRA, you keep getting paid more and more. So you'd have, you'd suddenly be on the cheering section, cheering for higher corporate tax rates. So your TRA would go up. So
and Dan, in terms of the TRA, I know it takes various forms and structuring, and I look at that chart and I'm not sure which way to go, but that's just part of the negotiation with the SPAC, right? In terms of
that's right.
So just another lever that you can pull as
it
you
is
SPAC,
just
right?
like you said, Lou, just another deal point, something to bargain for, another tax as another way to extract value from the de-SPAC transaction. And while Mark would tell you that if you're just negotiating, if it's just a straight IPO, you know, it's you don't really have someone specific to negotiate against on the other side. I think with a SPAC sponsor, you have, you know, one party you're negotiating with, and you can for good or for ill. I've certainly seen it cut both ways. And so,
Great.
you know, the next set of slides are a little bit complicated, and really, I don't think we need to go there here, but just kind of put those out. Let's go to the one slide I would like to talk about briefly, is slide 16, which is to put another term in your lexicon, which is a concept called the UP-C, or umbrella partnership transaction. And so this is a way in which going public, if you're a partnership today or an S Corp today, you don't have to surrender the benefits of being in flow through today, and you get to maximize you know, those TRA payments in the future. And then just one last point on slide 17 is, and Mark, I don't know if you've seen this yet. You mentioned the SPAC sponsor of an IPO for a carve out followed by a spin. I'm not sure, at least to me, I think that's been more conceptual than real. I don't know if you've actually seen that in a transaction yet.
Yeah, so there's about a half a dozen carve-outs that have actually been executed. Most recently, RDAG announced an $8.5 billion one, where just like in any corporate spin, The rationale is you have a trapped asset that has a higher value. In that case, they had a sustainable aluminum business that they effectively merged into a SPAC and are able to effectively unlock the value there. So it's coming, and the amount of dialogue that we're having with respect to these potential carve-out transactions and mergers with SPACs, if that's a leading indicator, which it always is, I'm sure it's really, really coming.
Yep. I mean, it's nice to be able to carve out a portion of your sub to come up with your cash as part of monetization and a spin, and it also gives you a point price for shares to do a split. So lots of good reasons to carve out before a spin, and with a SPAC on the other side, I think your speed to market gets to be pretty compelling.
And I'd say with the 450 active SPACs, the asset pool is going to get more and more competitive. So I think it would only be natural that companies are going to think of whether it's portfolio rationalization or other reasons to be structuring dispositions in the form of a SPAC. So I'd say if anyone listening is thinking about that, probably the most equally as important as anything else in those situations are the tax structuring considerations that you need to be doing as you're thinking about how am I going to carve out this business and what does that look like to untangle it from the RemainCo, if you will.
You guys, I got a couple more questions here for you. One relates to something that you just touched on there, Lou, with this huge number of SPACs and all of this capital ready to invest. And Mark, I think you said earlier that the timeline had collapsed from 18 months to get these things done down to 6 months. The question received is what are the post de-SPACing companies, with I guess, has the diligence decreased? If I'm reading this correctly, has the diligence decreased? Are these companies less high quality than maybe they should be? How are they surviving post de-SPACing, or how are they faring?
So we're in this interesting period in the evolution. We are absolutely, I think, pulling forward the IPO pipeline from 2022 and 2023 into today. It certainly remains to be seen how many of these companies are coming public too early. My sense is we are going to see some of these companies perform fantastically well. Some kind of get by, and there's going to be some fantastic blowups coming out of this cycle. There is an absolute trend and momentum on the litigation side as it relates to these deals. All the traditional IPO litigation, though that plaintiff's bar has not just woken up to, but they are as eager and having a field day right now as these SPAC transactions are getting done. With respect to diligence and kind of protecting yourself around this, it was so bespoke when we were talking about called a handful or a couple of dozen deals. Now, because I keep using the term institutionalized, there is effectively standards that are coming into play where you have check the box, rigorous diligence from top to bottom that is very much mirroring a regular way IPO process, much more so than ever before. So I think you're not seeing the speed impact the quality of the diligence necessarily in the processes that we're going through. But what you are seeing is, let's say, more effective and efficient diligence processes.
And I'd say there's a realization that some of these companies are starting to get pulled forward maybe a little bit more than they had been maybe last year. So part of what we're seeing in diligence is a lot of like public company diligence. So if you are an operating company that is considering being a target, I think getting some of that public company readiness roadmap and planning in process sooner rather than later. So when the SPAC diligence comes and knocks on your door and asks you what your plan is, you're kind of ready to walk them through that.
And then Lou, one for you. There's a question on financial reporting. How does it differ for SPACs versus a typical public company?
The SPAC itself, as I kind of talked about, is going to have the same financial statement requirements as any other public company. It's just a lot simpler because they just have cash on the balance sheet and then equity in their statement of shareholders' equity. So it's a heavily simplified structure. There's some other items you'll find on their balance sheet, and there's some interest on the trust, et cetera. So the SPAC itself, it's all similar, but just a very simple model. As the two companies merge, there is some relatively complex accounting that needs to take place to kind of affect the merger, but in essence, they're still in the same ballpark and operate under the same rules as any other public company would that goes through a merger or any other type of transaction.
Lou, is it possible that there's fewer years of reporting if on a merger as opposed to an S1?
No, I mean, if anything, there's certain scenarios where it might actually be the opposite. If you're a smaller reporting company or an SRC, so less than $100 million of revenue, you can avail yourself of having 2 years financials. If you're an EGC, which is less than $1 billion of revenue or $700 million of non-affiliate float, you can take advantage of the EGC rules. One of those rules is the number of years required in your initial annual report. EGC rules allow you to have 2. Sometimes if the SPAC has issued their first 10K already, you lose that year. So there are instances where a potential target could need 3 years versus 2 years if they were to take a traditional IPO. There are ways around that. So if you are contemplating it and want to kind of talk more about those, feel free to reach out to Mark or myself.
All right. And we are at the hour. So John, I hope this met expectations. I want to thank everyone for joining today and for your participation. We really appreciate it. If you do have questions, feel free to reach out to myself. We have a team here locally, very deep in SPACs, but I can also connect you with the presenters here today. And guys, thank you very much for your time and great work in doing the presentation.
Yeah, thank you all for your time. Very much appreciated. And for all those on the phone, I'd love to see a couple of new SPACs come out of Cincinnati. So